folks, Rick Wedell here. I'm the Chief Investment Officer at RFG Advisory. Thought we'd come to you today with a brief market update, kind of let you know what's going on out there. The market right now is a little bit reminding me of the proverbial duck swimming across the surface of the pond. If you look at the headline number, it looks very smooth. If you look at what's going on beneath the surface, there's a lot of churning and moving of feet. S&P 500 up right at about 10% year to date, which is by all accounts a good year. Once again, we normally think of equity assets returning about 10%. And the Russell 2000, which is those small and mid cap stocks, they're having a fantastic year, up about 19% year to date. And international stocks also having a pretty good year, outpacing the sort of domestic large cap space by about 3%. So up about 13.3% year to date. So once again, one of those years where diversification is working. I would also just note, if you look beneath the surface of that large cap space, you would see that like the Russell 1000 value index, so these are all the boring companies that are out there, value, code name, and investments for boring. So like I would be a value stock. They are up about 20% year to date. And the Russell 1000 growth index, so these are all the, exciting, sexy tech companies and everything that grows really, really quickly. Those companies are actually flat year to date. And this is a little bit where I talk about, that duck on the surface of the pond. You see these tough headlines, the NASDAQ lost about 3% last week. The MAG 7 is essentially flat on the year. SpaceX is down 31% from its opening price. You see these sort of headlines, which, CNBC and Fox Business, et cetera, can point to and be like, oh, you should be really scared out there. But what they don't point out is the fact that there's a lot of rotation going on between some of those higher growth sectors and some of the more boring sectors that are out there. And it's actually quite healthy from a market standpoint, so long as you're maintaining a broadly diversified portfolio. It's hard for me to get upset about anything that's happening in the market when we sit here right at the beginning of August and the market is already up 10% year over year. That's a strong performance. So lots of stuff going on under the surface. Always a good time to be diversified. I would also just note that bonds year to date, they're down about 0.7%, including their coupon, so effectively flat. And we've seen interest rates gradually move higher as it becomes more and more apparent to the marketplace that the Fed's next move should probably be up. So speaking of the Fed, let's tackle that next. Rates were kept stable at the last Fed meeting, and now the market is pricing in a modest hike by December of this year, but the movement is still higher. And we are in this environment where longer dated treasuries yield higher than shorter dated or the Fed funds rate, which is good. We are seeing 10-year yields approach the highs of the cycle, and that is really the bond market telling you that they think something needs to happen for the Fed to do something to step in and bring those inflation numbers under control. What you are also seeing is in this new Fed era, less communication on the part of the Fed chair. So the interview is a little bit less informative, a little bit less forward-looking and prescriptive, and a little bit more like, well, the market should kind of figure out what it wants it to do. And in a weird way, the market is actually doing exactly what the Fed wants it to. So keep in mind, when the market pushes those 10-year treasury yields up towards 10%, that puts a brake on the economy. And what the Fed's paradigm effectively now is, hey, bond market, stop trying to guess what we're going to do with the short-term interest rate picture. You look at what's going on with inflation and set your interest rates accordingly. And in that fashion, if that pushes long-term rates up, then that means that it will self-correct the economy and maybe correct some of that inflation in the near term. And so in a sense, despite the fact that interest rates are moving higher, I think that's actually what Warsh and the rest of the gang on the Fed kind of wants to happen. Away from the Fed, we certainly have the war. We had a little bit of a spat and a skirmish where we were shooting each other for a while. It now appears as of this morning that the administration has walked back from that and would like to return to the negotiating table to try and reopen the strait. And I think, what's happening a little bit without getting too political on it is it's very clear that Iran has control of the strait. Our ability to wrest it from them militarily seems very, very limited. And so I think the administration is just going to be in a game of like, okay, what is the minimum amount of damage that we can take to kind of try and get ourselves out of this thing? And you're going to be negotiating with something that's a little bit like the children's book. If you give a mouse a cookie, they're going to ask for a glass of milk. I don't know exactly where you stop Iran on, trying to get oil out of that region. But I will say this. Iran controlling the strait is better than, us shooting over the strait from a market perspective. So anything that moves those oil prices down is generally viewed positively by the markets. I don't think the market at this point really cares about what things look like before the war started. They just want to see oil flowing out of the Gulf. And then last but not least, we are in the middle of S&P 500 earnings season. We've seen about 300 companies report. So far, you're seeing a lot of really huge headline numbers, 60% earnings growth, 47% earnings growth. I will note that both Apple and Alphabet have had some one-times earnings hits that have really propelled up the weighted average growth rate. But still, even if you extract those elements out, we're seeing S&P 500 earnings growth average about 30% year over year, which is obviously huge, and is actually providing a little bit of valuation support underneath that sort of plus 10% number for the S&P. So the earnings picture looks quite good. With that, as always, if you have any questions, please feel free to reach out to myself or to your advisor. I hope you're having a great day, and I look forward to talking to you again soon.